this week's meme is the bush with the mask on it. This is kind of our. I know we're all at this point very familiar with COVID, and it seems now even our landscape is becoming familiar. So saw this one, and hopefully this isn't something we'll be seeing too much of, and we can all take our mask off hopefully soon, including the landscaping around here. So
Yeah, it's starting to feel like this is old news now, isn't it, Zach, after the way things are moving at light speed these days?
yeah, and certainly a lot going on out there right now with, as most are aware, there's certainly things that have moved to the forefront of the news and our attention, and many would say are more deserving at this point. But nonetheless, we've had a great experience in meeting with you, a lot of you online for calls and screen shares, and it's been really great to still be able to see some of your faces, but certainly looking forward to whenever we can meet in person again, and we are starting to phase that back in, as are most places. So, but this week, Bob, we're going to be discussing gift taxes or estate taxes. Pretty much, they're pretty much one and the same. And so a lot of people, actually, let me cut this off. A lot of people we find are, the rules around this are a little confusing. And I think most people walk away with an understanding that's different than what is actually the case. Has that been your experience, Bob?
Yeah, so like if you decide you want to give me $1 million tomorrow, which I'm in favor of, by the way,
I wish
is
that would be a nice place to be.
Yeah, no, you let me know if you want to do that, Zach. I'm all in. But if you do, what's the tax on that? Is there any tax on that? And
Right.
Of course that's kind of a silly example, but more often what we hear about it is people are interested and they've heard 13,000 or 14,000, or they're not sure how much it is, and they maybe want to give some money to their kids or their grandkids, and they're not sure, is that taxable, and they don't want to create tax problems for their kids. And so there's this general understanding that there are some rules out there, but there's not a lot of clarity about how it works. And so we're taking advantage of this weekly format to be able to just talk about one topic at a time and just kind of break it down. And we may have one or two people watching today that this will really help and give some clarity there.
Yeah, and most of the time, what we usually see, a lot of you on today's webinar, you might have had the desire to help out relatives, your kids, your grandkids, as Bob mentioned, and there's college, there's higher education, there's helping them buy a home, maybe, right? Maybe they're in a hard spot, and you just want to help them out. And so a lot of you have wanted to help them out, and the question is, okay, how much can I give to them without it being an issue? Is it an issue? And am I going to have to pay any tax when I do that? So we're gonna jump in. I'm going to share here in a second a table that shows what these historical rates have been, but there's basically two numbers that are important if you're thinking about giving money to someone. The first number is the lifetime exemption amount, and that is an amount, it's varied anywhere between 600,000 back 25 years ago. Currently today, it's over 11.5 million. And that lifetime exemption amount represents the amount that you can leave to someone at your death, and without having to pay estate taxes, or death taxes, they're commonly referred to. So believe it or not, if you wanted to give your son or daughter $30,000, that $11.5 million amount that I just mentioned, that is relevant when someone passes away, is affected by that $30,000 gift in the current year. And so that's really why gift taxes and estate taxes are kind of one and the same. They're linked. So I'm going to share a table that kind of shows that amount. Let's see here.
You know, Zach, while you're pulling that up, you mentioned, well, and actually this chart shows it back in 1997, if somebody left more than $600,000 at their death, the taxes were, you know, at the 55%, as much as 55%. That's not income taxes. That's just death taxes or estate taxes. And I remember having meeting people who, you know, they had their whole life savings, and maybe they had an IRA and they had a home with some equity in it, and they had 800, maybe $900,000 of net worth, and their kids were having to deal with this crazy estate tax calculation and pay
Hmm.
100, 150, $200,000 of their parents' lifetime estate in taxes, not even counting the income taxes that they might have ended up having to deal with on the IRA. So it used to be, it used to affect a lot more people than it does today. You know, since is you're going to kind of walk through this table and show us, you already mentioned the 11.5 million. So it's changed
Yeah,
a lot in 25 years because of the sheer amount. Um,
right. Yeah, and I can understand a lot of people were not happy about these death taxes or estate taxes because, you know, if you had saved up, you know, if you had earned an income and you pay taxes on when you get your salary, and then you save it up and some of it's in the bank and cash, and then, you know, back when it was the 600,000 amount, your heirs have to pay tax on it again. It's almost like it's being double taxed.
yeah.
So that was really what I think ruffled a lot of feathers with this. But the amount has gone from 600,000. It's increased considerably uh, over the last few years through various legislation that has been passed in pretty much every presidential administration has passed these. Democrat and Republican, they've been raised under both, and so um, we'll scroll down here a bit. So you can see it started out in 97 at 600,000. It kind of, usually these numbers have inflationary procedures applied to them to where they go up gradually. But then of course we get legislative changes that bump them up quite a bit overnight. So you can see that by 2010, the the lifetime exclusion amount had gone to 5 million. And then it kept going up, inflation. You get to 2018, and it jumped up to just over 11 million. And so you can see how the tax rate on the right column has changed over the years a little bit. It's varied between about 30 and 55%. Currently, the top bracket, the only way that these taxes would apply to you is if at your death, your estate's worth over an 11.5 million. So 99.9% of households out there, that's what I've been told, are not going to be affected by this. But again, going back to that, if you give somebody more than 15,000 in a single year, it still might create kind of a hassle for you. So that's what we're going to get into here in a second. So just to kind of recap this, currently today, you have 11.5 million as your lifetime exclusion amount, and that's for per person. So if you're married, each of you has 11.5 million. So between a married couple, they have over 23 million that they can give, that they can leave to their heirs. And the unique thing now that hasn't always been the case is if a spouse dies, their 11.5 million is portable and can be essentially transferred to the surviving spouse.
Yeah, that's a huge change that happened a few years back, and that has simplified things a good bit, because that used to not be the case. Explain how it used to work and why that was so complicated.
Yeah, it used to be that each person had their own amount, and you had it varied by state, because in some states you have community property and you have things that are jointly owned, and sometimes you have things that are individually owned. So each person had a separate amount, and if they didn't use their whole amount, it just went away. And so if you had a surviving spouse, maybe maybe their two amounts together, their estate was smaller than that, but one of them passed away and left stuff to the other spouse, and then their individual amount wasn't high enough to keep them underneath the limit.
Yeah, and the thing that happened there was you didn't have any tax, and you still don't from with a spouse leaving to another spouse. This exemption you're talking about is only if you leave it to a non-spouse.
Right.
So there was no problem at the first death, but you ended up effectively stacking two estates on top of each other, and you only had the one exemption in the prior law. But now you at least you still get the benefit of both exemptions.
Right.
So that's made planning that really impacted a lot of the estate planning we do, which is really not our topic today, but it's good that you started with this, because this really helps people, I think, understand the next part of these gifting rules you're going to get into.
Yeah. Before we move on from this 11.5 million amount, you'll see it continue to go up each year for inflation. So it's just going to keep marching up a bit. And then currently the law that raised it to this higher amount is going to expire after 2025. And so to keep it from dropping back down to the pre-2018 amount, that's 5.5 million. I mean, it's very uncommon for people to have estates larger than 11.5 million, but we know several people that have a 5.5 million. It starts to affect more people, and so if it jumps back down and Congress doesn't do anything to raise it back up or to keep it where it's at, then this may be an issue for some people that it's not an issue for today.
So Zachary, are you saying that we have to keep paying attention to this?
Yeah, exactly. We do. Yeah. I mean, especially, I mean, for some of you on the call, you may say, oh, well, we've been saving our whole life, our estate, including, all the real estate that we have and all of our investment accounts. Maybe it's at 2 or 3 million today for some of you. If it drops back down to 5.5 million 5 years from now, and your estate continues to grow, there's a chance that 10, 15 years down the road, that this could become an issue. So even though it might not be an issue for you today, we still like to keep an eye on these amounts and kind of keep that on our minds as estates start to grow in value.
Well, and the wild card, of course, always in this area, Zach, is that nobody knows what future Congresses are going to do. We've got this huge spike in debt now nationally, and we all kind of just in our gut know that there's going to be pressure on them finding more ways to raise tax revenue. So the past 10, 15 years, the winds have been blowing in, don't tax estates at such a low level, but who's to say it won't move in the other direction in the future? And all of that just puts importance on us in the planning process, always talking to each family about their unique situation. And today, for people who know they're going to have more than they're going to need their whole life, there's a lot more planning opportunities today because of these high limits. And we haven't had that sunset provision yet in 2025. So it's like every other part of the tax law. We always have to stay atop of what's going on, but also
I don't know if it's my internet or Bob's internet, but
did you lose me? I see you. Do you hear me? Hello?
Did you guys lose me? Did I?
Yeah, it bounced out for a second. Carry on. So I don't know where it dropped off. Anyway, clearly we have to always keep our eye on this stuff, Zach, and we always have to help clients understand that if they're inclined to want to do some giving during their lifetime, we're not always going to necessarily have as much room to do that as we do today. So we just always have to keep that in mind. Anyway, we got down into the weeds a little bit on that. I didn't know if you wanted to or not, but
yeah, it's just important to know this is something and to keep in mind. But going to shifting over into the gift tax, which does affect a lot of people, because a lot of people want to give sums of money to relatives or family that is over that 15,000 amount. So That 15,000 amount I keep mentioning is called the annual gift exclusion. And what that means is it's another amount that Congress has come up with in the tax code that says, if I as an individual want to give another individual money, I can give them up to $15,000, and it's like it never happened in the eyes of the government or the IRS. Now, once I give over $15,000, what happens? Well, any amount that I give over 15,000, so say I give 20,000 in a single year to a person, that's 5,000 over that annual amount limit. That 5,000 excess amount reduces the $11.5 million exclusion we were talking about earlier. So what they're trying to do is keep people from gifting their estate early so that they die with less than that 11.5 million, because some people are saying, hey, I don't want to die with this much, I'll just give it away before, and then I won't have to worry about estate tax. So in order to deter people from doing that, they have this very, very low amount. And so sometimes just in the last couple of months, I've talked with quite a few of you. I want to help my granddaughter with her first car. It's 20,000. Am I going to have to pay gift tax? Well, you will be affected by gift tax, but you won't actually have to pay any taxes on that. So if you give in that case, if you give over the 15,000, the IRS says you need to when you do your taxes, most of you in April, there is a gift tax return. It's a single form. It's available through Google, the IRS's website. It's form 709. That's this form here. And if you give more than 15,000 to an individual in a single year, they say you need to fill out this form. And it basically says, hey, I gave 20,000. And so the IRS keeps track, and they say, okay, we're going to deduct that 5,000 excess from your 11.5 million. And if you give so much over your life that you ever bring that, that 11.5 million down, then there's a chance that you might have to pay estate tax when you die. But pretty hard for most people to give away over 11.5 million.
So Zach, let's take these visuals down and let's just talk through some practical issues that we see. I know you have conversations around these gifting limits all the time with real clients. Some of the practical questions we get around that $15,000, and there's other things that there's some exceptions to that. Let's just kind of wrap up this session today talking about some real shoe leather type stuff.
Yeah, so one of the common things that we see people want to gift to their relatives for their grandkids a lot of times are for college expenses. And so there's college expenses is one of the things that you can gift to somebody without having to pay any gift taxes on. So you still actually have to file the gift tax return form that we were just looking at, since if you do give more than 15,000, but say you pay tuition, you have a grandchild that's at a private school, 30,000 tuition. If you pay the tuition for them and you send the money directly to the school and it doesn't actually go to the student, then it doesn't affect your 11.5 million amount, doesn't deduct it at all. If you paid 30,000 in tuition, you'd still have to file the gift tax return just to notify, but it's not going to affect things in the long run. And so that's one way. The other way is medical expenses. So if someone has a major healthcare issue in your family, say they're in a car accident, they break their back, they've got $300,000 in medical bills. Hopefully there's insurance that's going to kick in, but for things like cancer and other things where the expenses can go up, you can gift to somebody to cover medical bills. And if it goes direct to the institution that's providing the medical services, then that's another thing that you can do. And there's no, you still have to file that notification to the IRS, but it's not going to bring down your lifetime 11.5 million. And then the biggest thing is probably not just paying for, there's kind of a situation that is it's not really I want to pay for somebody today, but if you want to cover college expenses in the future and you want to give to somebody, say you have a grandchild that has a 529, you can donate into that 529 for their future college. That's a college savings plan account that is specifically created to be spent on college expenses. You can put up to 5 years worth of that 15,000 amount all at once, and it doesn't affect your lifetime exclusion amount. So you could do, if you had a grandson or granddaughter and you said the year they were born, you know what, I'm going to max fund their 529 account and I want to do it all at once to get it growing. You could, as an individual, you can do 75,000 into the 529. And if you're married, you and your spouse can together do 150,000.
Yeah, that's huge.
Yeah.
That's a huge contribution.
It's hard to imagine. I mean, inflation on college expenses has actually come down in the last few years. But it's hard to imagine a scenario. If you put in 150,000 and it's called super funding a 529 account and let that grow for 18 years when that grandchild is likely to need it. It's hard to imagine a college situation where that's not going to cover everything.
You know, Zach, we for other reasons, we're not super excited about 529 plans because they come with some restrictive provisions on how the money's used. But in a situation where you have you have more than you know you're going to need, and education is really a high value for the family. One of the things that's kind of cool to understand about those 529 plans and super funding is that say you've got 3 grandkids, and of course they're the most wonderful grandkids ever in the history of the world. We all know that. And you say, look, I don't know which one of them are going to go to college. I don't know which ones are going to, get scholarships. I don't know. So maybe you said, all right, I want to keep this simple, but I do want to take advantage of that super funding strategy, right?
Mm-hmm.
You could do something like this. You could open up a single 529 plan for the oldest and super fund that, put the 150 in, right? And then what's important to understand about those plans is that you can change once a year the beneficiary of the plan. And so you don't have to open up 50,000 into each of 3. You could put it all into the first one. And then if you did that, like you said, when they're really young, I mean, my gosh, if you've got 15 years, let's say, for that to grow tax-free, who knows what that could be worth in the future. And then let's say the oldest grandchild gets a scholarship because they're just that bright and they just need a little bit of that money. Well, then, you take the distributions and then you change the beneficiary to number 2 in line. And then you can kind of work through them like that. So in a weird way, it almost becomes like an educational trust, although it's not a trust. It's a specific kind of an account. But those are some of the creative things that are possible when you understand these rules that you're going over today.
Right. Yeah, and it's becoming more and more common for people to not just want to leave the legacy, the assets that they've been building. Say, okay, it's good. I want to be able to leave something to my heirs and my family. But more and more we see people wanting, they're saying to themselves, you know what? I want them to be able to enjoy that while I'm alive. And I want to be able to enjoy them enjoying it. I want to see them be able to enjoy that. And so whether it's a 529 account for college or helping a grandkid with a down payment on a house or something like that. People want more and more, it seems like, to be able to bless their family while they're still alive.
Hey, Zach, we've only got about 5 minutes. I want to make sure we cover something that probably comes up in this area more than any other question we get. And that's, how are these gifts? Let's say we understand the 15,000 or the 30,000 for a couple giving to our kids. Are those income taxable to our kids? Because that's probably the most common question we get, and it's a good question. You don't want to throw $30,000 of taxable income on them, and then they don't have the money to pay the tax, right? So let's make sure we cover that before we run out of time today.
Right. So that is not when you give money to someone in your family, that's not considered earned income, and so it's not taxable. If just as a hypothetical scenario, say you wanted to give you and your spouse wanted to give $60,000 to your granddaughter and her husband, um, uh, grandson-in-law. Um, if you wanted, could you do that? Could you and your spouse give $60,000 to your grandchild and their spouse? And would there be who would pay taxes on it, and how would you need to give that to them? Well, $60,000 is coincidentally 4 times that 15,000 amount. And remember that 15,000 amount's actually per person. So you as an individual could give 15,000 to your granddaughter and 15,000 to her husband. And then your spouse as an individual could give 15,000 to your granddaughter and 15,000 to her husband. So you've given 4 gifts. So the 2 of you have each made 2 gifts to other individuals. And so if you're a married couple and you want to give a gift to another married couple, you can give them $60,000 in a single year. You don't have to file a gift tax return. The people that receive the gift will not have to pay any taxes, and you will not have to pay any taxes. So that's kind of the limit if a married couple is given to a married couple. But there's a caveat here. If you have to write separate checks for each 15,000 amount. And so if you wrote a $30,000 check or the full $60,000 check, that's considered a split gift. And the IRS says if you give a split gift with another person, you have to file the tax return. Doesn't matter if it's under that 60,000 collective amount. So I hope that helps, and some of you, and a lot of times people think the most common misunderstanding that we see is that people think, oh, if I give over $15,000, there's going to be taxes that have been paid, and that might be it might affect some things that cause that to happen far down the road, but it's not like it's going to create tax for you in the current year most of the time.
Hey, Zach, one other question on that. A lot of times people's financial assets are mainly in IRAs and those kind of accounts. What if they gave a $15,000 gift to their grandchild in that example, but they pulled it out of their IRA and made the gift that way? What's the taxation on that?
So if you took it out of your own IRA, then any money that's in the IRA has not been taxed yet. So if you take that from your IRA and gift it, you as the giver of the gift is going to have to pay tax, not because you gifted it or not because of the amount, but simply any dollar from the very first dollar that comes out of an IRA, taxes are due on that.
Yeah. Well, you've done a great job of summarizing these rules, Zach, and there's infinite numbers of scenarios that could come up. Why don't you wrap us up and tell, if people have specific questions, tell them, what we always tell them.
Yeah. So, would love to speak with you guys. If you have any further questions, you can shoot those to my email, Bob's email, Sydney, Anna, Stephanie. We'll follow up with you directly. And I'm sure some of you are thinking of all the gifting that you can do now, and maybe you feel a little bit more free to do that. We hope so, and we hope that you're not that you can have the joy of doing that without fear that you're going to have to pay a bunch of tax. So,
and what are we talking about next week
today? And any last words, Bob?
Well, I was just going to say next week we're going to touch on a completely different topic that may sound boring, but it's actually a fun one to talk about. There's this phrase called aggregation out there. You may already know what that means, you may not, but technology is giving us tools as advisors today that we couldn't dream of 20 years ago. And we're going to kind of introduce you to what that looks like. We're going to show you how it looks in our tools that we use to work with you. And we're going to explain to you why it's not only helpful to us as your advisors, but also why it's an advantage for you. So we'll break that down next week. But enjoyed this topic today, Zach. You did a great job going over this.
Thanks for joining us, everyone. You guys have a great week, and we'll talk to you guys soon.